Jonathan Golub, he's the chief U.S. market strategist at UBS. And from Newton, Massachusetts today, David Kelly, chief market strategist for JPMorgan Funds. Gentlemen, good morning. Jonathan, I'll start with you since you're sitting right next to me. We've talked frequently about your expectations for the market. You're looking for the S&P 500 to hit 1475 by year end. How do these disappointing, and there's no other way to describe them, economic indicators play into what you think is happening right now?
Right. I mean, the first thing is I think that you need to man up and say, you not only, this isn't a disappointing day.
Man up?
Yeah,
I'm out. Hello.
But
the gauntlet has been thrown.
Man up. You know what? Actually, David, it's your turn. What do you think? No.
Oh, man. I mean, at the end, not only have you seen disappointing numbers today, and not only seeing, some negative news flow out of Europe with the Spanish banks and the like, but this is really about a month where every piece of incremental data appears to be, or at least feels like, it's to the downside. So
no, that's not true. Housing starts were faster than expected, for example, right? Initial, there was another one. Industrial production rose
you're taking David's role to tell you all the positive things that are going on in the marketplace. But it does feel, when I'm talking to investors, the tone of the market's turned substantially more negative. But if you look at the way the market's trading, I think that there's a ton of bad news already in. I mean, if you look at where the bond market's trading with a yield of under 1.8, if you look at where multiples are in stocks, the market is basically, the tone is where it was at the very low during the financial crisis. And I think that ultimately the risk is to the upside from here.
David, what do you say? This market needs to man up?
Well, I think what we need to do is look at the numbers realistically. I know, we like to make a big deal out of the Philly Fed headline. The Philly Fed has often surprised a lot. It's a small sample of one area of U.S. manufacturing. It's a small area of one area of the U.S. economy. The New York Fed survey was a lot more positive earlier on this week. But broadly speaking, when we look at the U.S. economic numbers, the U.S. economy is gradually improving. We want it to improve faster. It's like watching paint dry, and that's why we get frustrated. But it is growing at about a 2 to 3% pace. And when you look at what the U.S. economy is doing, which is gradually getting better, and then you look at the European economy, which has clearly got a lot of problems, and you look at some issues in China with a bit of a slowdown, I still think that the U.S. has got the clearest path to stronger growth around the world. And that's why, I would be in favor of U.S. equities relative to other equity markets around the world.
David, why then, and Jonathan, I'll put this question to you as well, if that's the case, if the numbers don't lie, why is it that we see the 10-year yield at $1.75? Why is it, for example, that Freddie Mac reported today that the 30-year fixed rate on mortgages dropped to a record low 3.79? Surely that has to say something about the health of the U.S. economy.
Well, I think I'd be interested to know what Jonathan thinks about this too. But on the 10-year, remember that we have two things. We've had a 31-year bull market in treasuries, and that has breeded a degree of complacency like I've never seen in any market. I mean, people are convinced they cannot lose money in bonds, and I think that is that's part of that story. And then the second thing is we know the Federal Reserve has been actively manipulating this market. I mean, they've been deliberately pushing it down. I think that there is this confidence that if interest rates ever go up, the Federal Reserve will step in to bring them down. So I think that's why you're getting these low rates. I do not think it is a measure of honest opinion about where the U.S. economy in particular is going, but even where the global economy is going.
And I'd say I agree with David, but there's no question when you have a 10-year under 1.8, you have either one of two concerns. Either there's a flight to safety towards the U.S. for the reasons that Dave said, which is that this is a much healthier environment. And again, as much as I said that the data's been negative, economic surprises in the last week or two have actually in the U.S. been the only market where they're incrementally to the upside in aggregate. So a flight to safety is one reason. The other is I think that investors are coming to the conclusion that given all of these macro headwinds, including the fiscal cliff and things like that in the U.S., that we are likely in a slower growing environment, and that's what's being reflected in treasuries.
But given the opportunity, right, investors don't seem to be making a choice in favor of equities. And that's a little puzzling because we see the euro weakening. We've seen the dollar index soaring. Money appears to be flowing into U.S. dollar-denominated assets. It's just not going into stocks pretty clearly.
Eric, but that's also because I pump the credit markets on Bloomberg Television every day.
But, I mean, if
go ahead.
Jump in, David. Go ahead. Jonathan will be back.
I was all right. Overall, I don't think we should be surprised that markets are behaving irrationally. We've seen plenty of this over the last 12 years. I think people are conditioned to believe that the U.S. economy can't grow. They're conditioned to feel very negative about it. And bonds have been very safe for many years. And I think that's what's really driving this. But just look at the numbers. If you look at housing, for example, housing starts, forget about April. On a year-to-date basis, housing starts are up 24%. On a year-to-date basis, our exports are up 8%. On a year-to-date basis, our auto sales are up 11%. The numbers in the United States are not just better than the numbers in Europe, they're actually better than the numbers in China in those areas. And so when we look at the U.S. economy, it is actually on a growth path here. It's just, there's a lot of noise. And I don't think people quite appreciate that.
Yeah.
But David, I turn to you on this. We talk about a flight to safety. This is a global economy, and even U.S. corporates, they have exposure to Europe. They have exposure to China. So what exactly does a flight to quality mean?
I think there's two issues here. I think that if we talk about equities, what you were talking about before, the real story here is not the incremental weakness in the economy. It's that, the companies are delivering really strong earnings, which are almost appear to levitate compared to the economy. You had an 8% growth rate in corporate earnings this past quarter. Expectations we would have 2% growth. You got 8% growth. The surprises to the upside. Analysts and investors are underestimating how good a job company management is able to deliver earnings in a rougher environment.
Like Walmart, for example, today.
Right, and Walmart was mostly a revenue story. You had about a 2% beat mostly on revenues, but you're seeing companies doing on the revenue line and on the margin line, and I think that to me is the most important story, not whether housing starts are incrementally better or worse than people expect.
Thank you for joining us, Jonathan.
I think to
jump in for a quick one,
just
David.
to add to that. Okay, what I think Jonathan and I are both saying is people are prejudiced against stocks, but over time, a prejudice will fade if it's not supported by the facts. I don't think the facts support a prejudice against stocks right now.